Hi guys, welcome to Investing with JYK, and today we'll talk about something very similar to Quantopian, but different. So, a viewer, Andrew, has suggested that I explain how the programming is done, and he has no idea how to code. So, I actually built a website that was my friend or partner, however you want to say it, but to um, solve just that problem, because Quantopian really wants you to code yourself, and as I understand, not that many people are into coding, or you know. So what I then try to do is build a website so you can run backtests without learning how to code. So this is a website I built with my friends, was with my partner and my wife as well. We are still trying to build it up. So at the moment, this UI is quite primitive and is not much. A lot of functionality is limited. But I can show you how this thing works, and then we can go on from there. So first of all, we can look at an example, right? So what it does, as there's an actual example that you can look at. Essentially, what happened here was I selected, I ran a back test from 2002 all the way to 2017. May of 2017, and the criteria that I used was return on asset (ROA) between 0 and 50%, and EV over EBITDA between 0 and 10, gross margin between 0 and 80. So just some stuff, and then the market cap is between 200 million and a trillion, and it gets the smallest 25 stocks, the 25 stocks with the lowest EV to EBITDA ratio that satisfies all these four criteria. And then it does a monthly rebalancing, so the transaction goes on every month, and that was the result. So the annualized return was about 13% if you follow this strategy. And if you are interested, you can download the transaction details. But for now, the transaction details that I have is quite cryptic. So essentially, you can see that I haven't done anything fancy to do it. So basically, let me think what happened here. Oh, these are actually okay. Yeah, sorry, that's correct. It's the transaction detail. So amount is really number of shares. I should just call it number of shares, but it's amount. So on the January of 2002, these things were purchased. 207 shares of this and 197 shares of this, and I don't know what those are. Let's see if we can find something similar at the end. Maybe there is EGY, no, or EYG, no. Okay. Yeah, so those are all the transactions, and that's the price, and that's the time. So that's the details, but let's not look too far into this. Let's just look at, so that's the, if you want me to explain a bit more on what this is, I think it's self-explanatory. If you want more, just leave a comment below and I'll try to explain that. So how do we use this stuff? So essentially, you can add some filtering steps, very similar to the pipeline that I had in a Quantopian thing. You have filtering steps, and then you got a sorting stage, and then you have time, and rebalancing frequency. And then we have is like. I typed love, but yeah, you know. And then you can put your email to get the notification. So what metrics we support? I actually support some over here. I think revenue is disabled. Yeah, actually disable revenue. But anyways, these are the things. Some of these things we support. You got, you know, price to earnings ratio, and if you click, it just takes you to Investopedia and tells you what PE ratios are. And in the future, this will be slightly better, and then we'll have EV to EBITDA, same thing. You know. So let's say that we want to run something that doesn't have too much debt. Let's say I want a 0 to 50%, right? And then I want another thing. I want it to be profitable. So net profit margin should at least be 5%, maybe 2%. And maximum, say 30. You could even type 100, which means there's a no limit. So at least 2%, basically. And maybe I also want to say it should be relatively cheap, so price to book cannot exceed 1.5. That's from Intelligent Investor, basically. Benjamin Graham insists on 1.5. Just some random stuff. Okay, then we also want some sorting things. Let's say we want to do again cheapest. We want the small things with the smallest PE that satisfy these criteria. And I want to do so. Currently, the furthest we support is to May 1st, 2017. That can be changed, but we haven't. We actually have the updates running, and then we're also working on the UI updates. But for now, just stick with that. This is the earliest we support. This is the latest we support. And how often we like to rebalance? Maybe weekly. Every week we're gonna rebalance, and then we can run 20 stocks, and you can put whatever you want here. It's only there to retrieve your thing. So let's just put my email address there. And if you want to subscribe, you can subscribe. If you don't worry about it. And you submit. And that kicks off a job on my laptop. Yay! Well, not mine, my partner's laptop. The fan will start spinning like crazy. But it will probably take like 5 minutes. So let's see. Check my result. Currently it's not ready. It will say it's waiting. So let's see. Probably take like 3 minutes. So while we're waiting, let's look at the example again. On top, basically what you get is some statistics. What is your total return versus an annualized return, and S&P 500 return, and annualized return. Alpha, beta. Beta is how correlated you are to S&P 500. Sharp ratio, how much alpha you're getting for the beta you're suffering. Sortino is some basically upside beta, I think. It's either I think it's upside beta. Volatility is I actually forgot how this thing's calculated, but essentially smaller better for your heart, for your psychology, not necessarily for the portfolio, because if you leave it there 20 years and volatility isn't too much of an issue, and you got maximum drawdown is like what is the peak to trough difference, the biggest difference. I think that probably happened between here and here. 55% drawdown, that's about the same as S&P, I think. Let's see, 2008, oops, SP 500 drawdown. Where is it down there? Key dates and milestones. Drawdown. Nope, nothing. What the hell? 100 years. Let's take a look. 2008. Well, worst drawdown. So we have a winner. Yeah, here, 85%. Imagine you sit through that. Holy shit. Yeah, 1933. In case you can't see, that's 1933. 85% drawdown. 2009, you got about a 50% drawdown. Mine was a 55, so it's more volatile than the actual S&P. So those are things you might be interested about, and here's the transaction details. Now, if you think about how I run it, I actually just run it on a database. I have a database of all these all the past data. So imagine if we were to run a similar screener. It's still running. I want long-term debt to equity ratio between 0 and 50%. So let's see. So let's say select. Is there a long-term debt? L. Debt to equity. I think DE. Actually, I forgot which one it is. Maybe it's actually not long-term, it's just debt to equity. Anyway, imagine we just had debt to equity ratio. Let's see what DE from daily data where ticker equals, say, let's look at APL, Apple, and date key equals, I don't know, 2008, sometime in 2008, maybe 0601. I think DE is that. Let me just double check. Oop, wrong. So I actually got the data from Quando. I paid for the data. Where are we? Am I logged in? Am I logged in? Am I logged in? I am. Can't see. No. Sharada fundamentals. Yeah. So the definition is around here. Methodology. No. Started ticker. Okay. So DE. That's not very useful. Sorry, I forgot where that thing is. Usage, data export. Oh well. Let's ignore the debt to equity ratio. Let's do the rest because I forgot. What do we have? We have net profit margin greater than something. So essentially, I want to select. Let's just make it simple, right? So we want things. Let's imagine if we just did those two things. Price the book between 0 and 1.5, and I want the smallest PE ratio. Okay, so select ticker, PB, PE1. There's two ways of calculating PE, and I just use PE1. I will later put these definitions on the website so you guys can see. From daily data where PB greater than 0 and PB smaller than 1.5 and order by PE1. I want the smallest first, so ascending, and I want only 20, so limit 20. Oh, and then I also want a date. So if we were running this, it will start at the beginning of 2002. So it'll be 2002. That day is not the beginning of the week because there's nothing trading. I think it's a third. I think it's a third or the second. But anyway, we can do that for any trading day. So let's do that, and date key equals 2002-0103. Okay, let's see if this works. Here we go. Oh, that's not gonna work because all these negative PE, they're all losing money. No, this is gonna turn out to be horrible. But let's say we add another thing, right? So let's say we want the PE. So that backtest is probably going to go to hell. But let's imagine that we limit the PE to be greater than 0 so that we get rid of all the money-losing companies. And here we go. You got whoever this company is. So what will happen is we'll buy all these companies and we will have equal weight on them, so we'll split the portfolio into 20 pieces and buy all of them. So on the next rebalance, which will be a week later, I think. Yeah, weekly, so a week later, so 7 days later, maybe, right? So you add a 7 to this, and it'll be a different thing, and you'll be like, okay, did anything change? This is the same, this is the same, but you can see the order has changed, some of the price has changed, and maybe, let's see, RC is still there, Char is still up here, Ray, Cryo is a BX max. Yeah, so here we got a max that we have to include, and then somebody got kicked out. This MNPQ something is no longer in here. So what will happen is we'll sell this out to 0. We will buy this max thing. And also for everything else, because the price has changed, now you're out of balance. So you are now, say, you know, maybe this Bex thing, maybe it changed in terms of, you know, price. It went down. It used to be 1.22 PE, now it's 1.15, and you that means this price has gone down. So we're gonna buy more of that to make sure again everything has equal weight. So that's essentially what it does. You repeat that every week. You find the things that are cheap that week, and you get rid of everything that has gone more expensive comparatively to the cheapest 20. You sell that, and then you make sure that you get an equal weight on every single position. That's the gist of the whole thing. And in fact, the thing has finished running. And you can see that because we didn't include any, we did not exclude any negatively like earning companies. There's no outperformance and on top of that, in fact, there's a underperformance of a little bit, and the volatility is very high. You know, 74% drawdown, so it's a pretty bad backtest. Right? So if we were to try to make it better, we would. Oh, by the way, you can check what you have by just that. So that will show you all the things, which means at the moment there's no authentication, so you can check everybody else's. But we will change that so to include authentication. So if you don't want to share your stuff, you can just, you have a password and something like that. But maybe I want to, do something. Let's say we're just gonna do. Again, we'll make sure that PE is minimum 0, maximum 100 or 1000 or something like that. And I want it to be not much debt. And again, let's rank them by smallest. Weekly, 20 stocks. And you just submit. Obviously, it's going to take a while. So you see the old one, but the new one is still coming in. I mean, you can do some stuff. You can make it bigger, make it smaller, whatever. So that's what I did. And if you're interested, take a play. Don't submit a shit ton at the same time. Wait for one to finish before you do another one. Otherwise, we'll kill my laptop. And, well, not mine, my partner's laptop. And hopefully this will be useful and help you validate some of the thoughts that you may have in terms of how to select securities. And I'm also trying to make this stuff. I'm trying to add a functionality so that this functions with Robinhood, and it can automatically trade in Robinhood for you. I intend to have this thing trade for me so that, portion of my portfolio is now will be then automatically managed by something that is not subject to my human brain's biases, because we suffer all these emotional problems, and that will get reflected in our investing investing decisions. That will be all for today, and let me know if you're interested in this, and give it a try. If you think this is useful, I might just quit my job and do this. And thank you very much. See you next time.